Please raise your hand at any point if you think we need a microphone. Okay? Tonight, of course, our guest is Mr. Sobhy, a very gracious parent who's come to help us on this journey towards long-term financial success and, for some, maybe retirement. He's the head of both an investment banking firm and also a financial counseling firm. And he's here to speak for a while, but we will have time for Q&A or a period when you can come up after and talk to him. And of course, he will tell you a little about the internship on Wall Street. I give you Mr. Sobhy.
Thank you, Dr. Miller, and thank you all at Blair for having me here tonight. I'm very excited to be here, but I just have to start with my first slide to warn you about the presentation. So here's an interpretation of Sir Winston Churchill of what's a good presentation, because I can assure you I will not give you a good presentation tonight. So I did a little bit of rendering, because I believe in a longer skirt to cover all what you want. So that's what you should expect, because this is a big subject. Okay? So I beg to differ with Sir Winston Churchill on this. We will talk about a lot of subjects, and I want to cover as much as I can. It's a big subject, which is investment, but we need to talk about it in a way that makes it really inviting, because it's more about your awareness of what's out there than really knowing all the solutions that you need to have tonight. And the awareness starts with, just with a show of hand, how many of you have an investment account or have invested before? Okay, so from just the small percentage that raised their hand, I can assure you that all of you are investors. You just don't know it yet. And the reason I can assure you, because investment really starts with investing in yourself. So all of you have made this investment already by having a better education, by looking into accumulating a lot of knowledge, which will allow you to really have a return on investment. So all of you should be so encouraged that you already made this decision and you're already there as an investor. And we will talk more about other asset class beyond yourself, but you have to always remember you are your biggest asset all the time. I'm going to go through step by step. The theme that I really want to address is I want you to approach investment as an open book exam. Like everything in life, you will need a lot of information, but be encouraged that you just can look it up. The information is there, and you just simply need to make the effort to look it up. Our discussion points today, we will talk about knowledge of investment, we will talk about the essential and the tools, and some of the investment products that are out there. One of the first components of investment is really a stock. And a stock is a share of a company. And I have a lot of short videos that you will see that describes each element. But a stock is really a share of a company. So think about you want to purchase a share of a company to be an investor. Once you invest in a company, you become a shareholder. And this is a simple look of what a Microsoft share would look like, share certificate, what a Facebook share certificate would look like. Once you buy one of these certificates, you become a shareholder. So let's look at something much easier to go through, which is a video that describes what a stock is.
A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Full Flag Cycling. This company makes bikes. Really good bikes. The bikes are so good, in fact, the company wants to expand so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that offers better returns than a savings account. He is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So, how much does a share cost? Suppose the company is valued at $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1,000th of Bull Flag Cycling. Because the company is valued at $1 million, each share would initially be valued at $1,000. Our investor purchases a single share through his online stockbroker for $1,000. Now let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the price of the stock. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to making money in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with the increased risk comes the potential for greater returns. Savvy investors take precautions to minimize risk, like creating an investing plan, adding diversity to their portfolio.
So you get an idea of what a stock is, a much better way of explaining it in this video, hopefully, than how I did it. And this is an example of how stocks really reside. Take the Dow Jones Industrial, which is a composite of 30 stocks. And when you look at the different logos, you would see some of it, or all of it, or most of it you would recognize, and all of it companies we use. So the Dow Industrial consists of 30 stocks that are followed by all investment professionals, and there is a way you can buy a basket that just reflects that index. The S&P 500 is a similar index, but it has bigger number of shares of companies, which is 500 largest US companies. So between these two indices, these are the indices that are followed by most to give them a direction of where the market is, because it is really indicative of the majority of the large companies out there. The second big part of investment is, we covered the stock, the bonds. The bond is the second component that has a distinct difference from a stock. A bond is an obligation, so when a company issues a bond, it has an obligation to you that we will have to pay you the principal plus an agreed upon interest, which is part of the terms of that obligation. As you can see, the bond will have some sort of a guaranteed principal back, and there will be a steady income that you know what it is, unlike the stocks that goes up and down when you have an actual appreciation or depreciation of the value of the company. And we'll have similar explanation on a short video of what a bond is.
So let's explore what a bond is and how it could benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Investors use bonds to preserve the money they have while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are commonly used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview will pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest payments continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, although returns are typically greater, profits and losses are driven by market forces and are considerably less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends on the financial stability of the issuer. For example, most governments are considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies, such as Moody's and Standard & Poor's, assign rankings to different bonds. This allows bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk, so it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate, so be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up and any bonds you own will be worth less if sold before their maturity date. After all, when interest rates rise, more investors allocate their money into new, higher interest rate bonds. If you want to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. So what role can bonds play in a diversified portfolio? For many investors, bonds are a way to preserve capital and generate income. Investors often use a mix of stocks and bonds to achieve investment goals, and because bonds move differently from stocks, they can help increase or protect portfolio returns.
Okay, so we get a pretty good idea what the difference of the stock and a bond. This is a certificate, this is actually a bond certificate, which is pretty much a collector's item now because bonds will not be in physical form like this, but I thought it would be interesting for you to see how it looks like. This is the face value of it would be described this way, and the little ones here will be the coupons, which you actually flip them and go redeem them for your interest rate. So everything is trading electronically now, and of course this is like a museum quality image. So just overall, just to sum up the difference between a stock and a bond, all what you really need to know, each of them has risk, and the risk is kind of varies between a guaranteed principal, which is a bond. So it has the risk of default, obviously, like we saw. But the stock would have really a different category of risk because the company has to do well, so for the shares to go higher. So there's so many variables that goes into this. So just keep that in mind when you are looking into the variation between a bond and a stock. These are other tools of investment that are coming up that you'll see. Terms you probably heard before: mutual funds, hedge funds, ETFs. ETF stands for electronically trading funds, which is basically mirror a specific index or a stock or a basket or a sector, healthcare, mining, technology, or what have you, and they create an electronic trading funds that mirrors that, so you can invest in it in one share. Commodity contracts, options, structured investment products. You just need to have general idea that there are so many different variations of tools of investment that are out there. Now, where all this happens, I find interesting, one of the senior traders on New York Stock Exchange floor had created a tour to the New York Stock Exchange floor where most of the big board trades happen. So I will share this video with you. I hope you find it interesting.
Welcome you to the New York floor, the New York Stock Exchange, and I'm going to take you on a tour of the exchange. We're in what we call the main room, and you need to look at this beautiful ceiling because this is a This is a spectacular room, and it's been here as long as the exchange has been here, which is well over 100 years. The specialists are at the kiosks that we see around us, trading different stocks, and the brokers communicating with their clients are lined all around the room. So now what I do as a broker, my responsibility is to represent my clients on the trading floor. I guess I should be 95, right? Buying the stock as cheaply as I can or selling it as dearly as I can. And I call the client the dog. The dog can live in London, the dog can live in San Francisco. The dog is the decision maker. All I'm doing is implementing that process. So we just got an order. And so what I'm going to do is I'm going to enter this order, trades right here electronically, and then we'll go over and see what the stock looks like. See, we're going to go to where this particular stock trades. So it trades at post 4 section S, so we walk around post 4. This is all Goldman Sachs, Spear Leads. They're the dealers in all these stocks. The stock is GGP. GGP, can you tell me how GGP is?
GDP is 30,000 off of 21 cents right now.
Right. Thank you very much. A broker, of course, has his orders, but he's always looking up to get a sense of what the market is doing, reading the headlines, looking at what oil's doing, looking at what gold is doing, looking at what the Dow is doing, looking at the currencies, and I guess if he needs to know, looking at what time it is around the world. Well, when I come to work every day, this is exactly where I come. This is Seaport Security location on the trading floor. My clerk, Lewis, is here, and Lewis, come say hello. And we actually are on the trading floor about 8 or 8:15 every morning. Lewis is here, and I think a lot of money changes hands. A lot of money. Is it gambling? I guess it's all in the eyes of the beholder. Certainly there is a huge risk element to it, so if there's risk, I guess it's fair to say it is a form of gambling. I don't choose to see it that way. If I want to gamble, I go to Las Vegas. And now, to continue our tour, this is the podium where they ring the bell, and at 4 o'clock they ring a bell, and trading in. Somebody presses a button, the bell goes off, the hammer down, like at the docket, and it's over. And it happens at exactly 4 o'clock every day. It's never changed. And luckily in these bad markets, I'm glad it's over at 4 o'clock, because by 4 o'clock you've had enough, you just want to go home.
So this is a trader point of view, and as we go forward in the discussion tonight, you will see that there are different views than just a trader's view. But I thought it's interesting for you to see it firsthand, how a trader reacts with an actual order, how they trade, and their thinking of timing and everything. So one of the parts what we really want to look into is investors' bias and psychology. It's really a very big part of the investment thesis of how you determine your rational decisions or irrational decisions, for that matter, when you make investment decisions. So there's some very credible research. You can see just now reading what's out there gives you an idea that sometimes we make decisions that we really don't want, but because we are in a certain emotional state that makes us do these decisions, like buying more food when you're hungry, when you're in the supermarket, and so on. So University of Cambridge PhD researchers have came up with a study to identify the bias of investors and what's their psychology and how they think of it. And it's a very interesting study that when you go through it, you will see that a lot of these things, we all go through it, and hopefully you will relate to some of it. And these are the list of different investors' bias. Over-optimism. Am I always confident in my ability in investment with limited knowledge? And the staggering study shows that 88% of investors feel that they are confident in their ability of investing. So this is great. We always want to be encouraged to be confident in everything we do. But when you don't have the proper knowledge to make a wise decision, it is difficult when you are overconfident or over-optimistic, because you underestimate the risk. You underestimate the risk of investment. That's where losses occur. Present bias. Am I too stuck in the here and now, and I want to settle for short or small return for a short-term period versus a longer or a bigger return for a longer term period? That's a very important characteristic. A lot of people would be thinking, I want a small return now, but I don't want to wait for the long cycle. Projection bias is your estimate of your retirement requirement is tied to where you are today, because your circumstances might significantly change in the future. So that's one of the bias that we need to be aware of. Loss aversion, which is extremely common in investment. Everybody fears loss. Nobody wants to invest because you don't want to lose money. So, but if you lose money and you're too scared of that, you'd never invest. So you're out of that game completely. So that's one of the components that we need to catch ourselves and look into. Herd influence. It's very common in investment that people would invest in what's popular. Everybody's talking about different cycles. A drug company that makes a great drug, everybody's investing in it. If you talk about any type of sectors, it's a popular cycle, but that makes the investment crowded, and there are too many people overpaying for something that maybe you don't want to be part of that. And anxiety, which is something we all go through, whether we are presenting right now or whether we are investing, it's the same thing. We are worried about the unknown and the future. So an anxiety, sometimes you would see it when you invest, because you look at your investment and you watch it every day. The market is volatile. Your value is lower than what you invested, so you're very anxious. Sometimes you make wrong decisions when you allow yourself to fall into all this set of emotions. So that's a very important part of how you can really catch yourself emotionally, and then you strip that, take the emotion out of the equation, and you start looking objectively in how you invest. That's how you can really approach investment. So our very own Blair sample of risk tolerance. Our own Mr. Moore here was gracious enough to invite me to one of his classes, and we spoke to the students about investment. And I was keen at that time, knowing that I would be eventually speaking at Skeptics, I wanted to get an actual sample from Blair students of what is their risk tolerance. So we distributed this questionnaire. Actually, Mr. Moore isn't even in this sample, if I may disclose that, you know. So everybody had that questionnaire, and you would find from that, people answered a set of questions to determine what is your risk tolerance. And you will see the majority, 61%, have average risk tolerance. And the second highest number, 27%, have above average risk tolerance. And of course, you would see the outliers will be always the high risk or below average low risk, which is really indicative to what's out there in the world. So even that this is within Blair, it's a very small sample, and within the whole, town and state of New Jersey, it's a small sample, but it's indicative of what's out there. The majority of people would actually feel this way. Everybody has the ability of taking average risk, and they can live with it. But once you go into the higher extremes, nobody want to take no risk, because we all take risk every day and so on. And you should look at that when you're making investment decisions. But you have to know where you fall into this. And it's important to know this early so you can make better investment decisions. Now, with a lot of volatility, and I'm not sure, probably some of the students in economic class are following what's out there, I just selected oil and alternative energy to give you two short videos about, because everybody in the financial world is talking about oil as a commodity. And I think these two back-to-back short videos will give you an idea of why the world is so involved right now and why it's determining that the average stock market all over the world is down 20%. And oil is in front of center of this dilemma now. So I hope you enjoy this.
Oil. In the news, we constantly hear that the world is running out of oil. This should mean that worldwide supply will be smaller and the price of oil will be higher. However, the opposite is happening. Oil prices have dropped significantly, making oil relatively cheaper than ever. How is this possible? The price of oil, gas and coal is formed by supply and demand. Until recently, 3 forces influence this. Which forces are these? The first force is the growing importance of oil in our economy. We need oil for most heating, transportation, electricity, and it is a prime raw material for chemicals, fertilizer, and plastics. Because we use so much oil, the demand continues to increase. The second force is the emergence of monopoly positions. When capitalism reigns, multinational oil companies, merchants, and even individual investors can obtain monopoly positions in various parts of the production process. This allows them to set a price for their part of the process and hence impacts the overall price of oil. The third force is the collection of geopolitical games being played in order to gain political power. An example is the nationalization of oil companies in a country, allowing the government to control production supply and impact the price of oil. So, these 3 forces have always determined the price of oil. At the end of the 20th century, a 4th force has entered the scene. Burning oil is one of the main causes of global warming. Therefore, alternative forms of self-renewing energy must replace oil as soon as possible. For this to happen, the price of oil should be higher and therefore fairer than it is now. This would make renewable sources more attractive to use. However, the price of oil still seems to be controlled by monopoly positions and geopolitical games. So who is playing these games, keeping the price so low? You might think that multinational oil companies like BP and Shell are in charge. In reality, there are many more national and international players in the oil game. One of these players is the OPEC, the Organization of the Petroleum Exporting Countries. Forming this alliance of 12 already influential oil-producing countries made them powerful enough to determine worldwide supply and hence control the price in the past decades. However, in recent years, other players have also become powerful. To try to swiftly defeat this competition, OPEC has opened its oil taps completely, greatly increasing supply. This caused the price to have fallen so dramatically lately. Such a low price is not favorable for any oil-producing countries, so even the countries within OPEC are suffering. Yet, founder Saudi Arabia persists in hope of defeating competitors and securing OPEC's dominance in the worldwide oil trade. One of the powerful new players is Russia. Whenever OPEC carefully decreased production to stabilize the price of oil, Russia gradually increased its market share. This has resulted into Russia becoming one of the world's leading exporters of oil. Another major player, China, uses different tactics. Instead of taking on the competition, they economically stimulate several poor countries, mostly in Africa, in exchange for the rights to drill there and import the oil directly to China. This allows China to keep most of their oil trade away from the world market. The United States was always highly dependent on OPEC for their oil. In recent years, they have made great strides in extracting shale oil and gas, which is expensive and potentially harmful for the environment. Taking these risks made the US less dependent on other parties. With all these new players in the oil game, it seems that OPEC is losing the power to determine the oil price. So what will happen now? One scenario is that OPEC will succeed in crushing the new competition and have the power again. Or will all oil-producing parties survive with this low price? Or will there be a new dominant producer? All these scenarios rely on geopolitical games being able to keep oil an attractive source of energy, so that renewable energy sources don't stand a chance. But maybe the damage of oil on the environment will force oil to get a higher price, which would allow renewable energy sources to enter the market more rapidly. Is this just wishful thinking? Only time will tell.
So follow that, and we will look into alternative energy just back to back. You'll see how that will flow.
After a year in which oil prices dominated the news, you might think the same issues will drive next year's energy stories. But if you just focus on oil prices, you'll miss the larger picture for 2016. We rely on oil, of course, for transportation and petrochemicals, but it's not the only game in town anymore. As our reliance on oil shrinks, we'll turn not to just one new source of energy, but several. This is different than what's happened in the past. Previously, one form of energy was superseded by another. In the 19th century, our reliance on wood gave way to coal, and in the 20th century, that yielded to oil. But in the 21st century, the next step won't be an orderly progression from one fuel to the next. It'll be a free-for-all. So, which source stands the best shot? Let's get the easy answer out of the way first. It isn't going to be coal. Although Japan and China will add coal plants this year, coal's share of US electricity production has gone down 17% since 2005. Coal is just too dirty in the face of climate change. Nuclear energy isn't doing so hot these days either. Since Fukushima, several aging US plants have been closed, and Germany, Japan, Taiwan, and other countries are planning to phase out nuclear energy altogether. From there, though, the energy picture gets a lot sunnier. Natural gas is the big success story of the past few years, pouring out of US fracking projects and undercutting coal as a cheap source of electricity. Wind power is as cheap as coal in Germany and the UK, and demand for solar is actually the highest it's ever been, which may have something to do with the price of solar panels dropping 95% since 2008. In spite of all this upheaval, oil is still king. It's our single largest power source, and that's not going to change in 2016. Between high US output, Iran probably resuming its exports, and Saudi Arabia lowballing to maintain market share, oil prices are likely to stay low for a while, which means less incentive to find an alternative. But there's a funny thing about oil you may not have noticed. It doesn't really compete with the others directly. Oil mostly powers cars, ships, and planes, while the others mostly generate electricity. The wild card for oil in 2016 and beyond is how fast cars might start to run on electricity instead of gasoline or diesel. Even when we see a big shift, it may signal the true end of the oil age, but it won't be replaced by the solar age, or the biofuel age, or the wind age. It'll be replaced by all of them.
So why we are concerned about oil? Oil is the largest commodity, and as you can see from the next subject, volatility. Volatility impacts your investment, it impacts stock markets, and oil is a big contributor of that. And knowing what we have just seen in the past two videos, it gives you an idea how macro volatility has an impact, and it becomes always a backdrop for each stock markets all over the world, the macro volatility, including nations, political conflicts, all these things. We've seen pieces of it in the videos we looked at addressing oil specifically as one commodity. The micro volatility that impacts your investment will be specific to the company. Company reports good earnings, your stock will go higher. They report bad earnings, the stock will go lower. So these are specific to actual investment you will be tied to going forward when you make selections of being invested in some companies. Company news. If a company discovered something new or invented something new and reported that, that will impact them positively, and vice versa. When they are working on something and it didn't work out and they announce that, it will impact them negatively. So how can we cope with all this volatility? Diversification, magic word. We need to focus on diversifying what we invest in. You have to look at different mix. Once you identify your risk tolerance, then you start to look into how you can diversify your investment with having a different basket. The things you see over there, stocks, bonds, money market, commodities, gold, currency, chances are for all of them to go down at the same time is unlikely, because there are a lot of macro and micro reasons for them to go in different mix. And if you have a good balanced portfolio, you usually be yielding an above average return. So that's just an example in this slide of what a diversified portfolio looks like for somebody that is a conservative investor or a moderate investor or an aggressive investor. And it determines of how much of a risk you take in each product or tool or investment piece you would have in your portfolio. Now, we talked about investment. Now, if we are not earning, we don't have anything to invest. So I just want to remind you, which I'm sure you heard many times, that college method. And this is just some statistics about the earning power of each individual as they increase their learning ability or their knowledge. So you can see the progression of $1 million more if you have a bachelor degrees over your lifetime than a high school, and it progresses as you do more higher education. Savings is extremely important in our cycle of investment, but also the selection of the different products you invest in will determine how much taxes you're paying on your return on investment. So start making selection of what you invest in as you go forward. Investing versus borrowing is a key point I'll touch on. Remember that when you borrow, you're paying interest, and when you invest, you are receiving interest. So remember just that image. And as you grow and have bigger things in your life, you would be borrowing. And when you borrow, just make some balanced decision. Do not get stuck in debt. You see this guy struggling with whatever he's getting. So just remember this image when you make decisions of taking debt in your life, and try to see how you can balance that with investment. Now we're going to talk about something very exciting, which is compounding and the power of compounding. And that's really the key thesis of how you can get to the next level once you start investing. But the bottom line is you really need to start now and early. That's just the bottom line and the important message. The earlier you start, the better off you will be. This slide would show an example of your performance of investment. So assume now we already made a decision. We're going to work hard, we're going to earn a lot of money, and we're going to invest it. Your choice of investment becomes now to the next level of how you can perform. If you look here, you'll see $1 for 25 years. If it's invested in U.S. Treasuries, it yields $5.50. And if it's invested in the S&P 500, which is, we all know it's riskier, and it's a basket of 500 stocks, that is how much it will be worth in the duration of 25. That's from the period of 1978 to 2015. Look here at how the impact of a higher return would be. This is a $100,000 example, which is irrelevant, the amount of dollars, but the point made here, at 7% return, that's how much you'll have of compounded interest. But if you just increase the return by 1% extra, you'll have an extra $61,000, all things are equal. So just get an idea of the performance that your investment, once you make the decision to invest, the performance will matter significantly. Here's a table that shows you an example of 5 years versus 40. So you can see that time is a big friend and big component to you, that you have plenty of it ahead of you. And you can see here the return and how it impacts the amount of money you'll be left with, assuming the old starts at $10,000 in this example. Compounding examples again of how when you reinvest your dividends or whatever returns you're getting, because you have an expectation of investing for the next 30 years, 40 years, and so on. If you reinvest all your returns because you only need it after 40 years and you made this conscious decision when you make your investment plans, if you leave it alone and you keep putting back investment into it, that's the power of compounding. You see the difference between somebody reinvesting the dividends versus someone just having the same growth. And this is driving growth from the very same investment, and this is somebody invests in fixed income that has modest return. All of them produce good returns, but it just gives you a good variation. And when you have time, you can afford to take slightly higher risk, and you should consider that. So we'll finish with this last video, I promise you, and that shows you what's the power of compounding.
Compound interest may be considered one of the most powerful concepts in finance. Compound interest is reinvesting earned interest back into the principal of an investment. Earning interest on top of interest increases the principal, resulting in exponential growth over time. Exponential growth is the acceleration of growth in an investment's principal. Exponential growth is the result of letting interest compound over time. This idea can be a little abstract, so let's look at a hypothetical scenario to better understand the power of compound interest. Suppose there are two investors who have a starting balance of $10,000 each. They both decide to buy the exact same investment on the same date, and they both plan to hold their investments for 30 years. But one investor plans to withdraw the interest at the end of each year, while the other plans to reinvest the interest and let it compound. Let's fast forward 30 years to see the difference in potential returns. In this example, let's suppose that the investment earned 5% per year. The investor withdrawing interest every year would have earned $500 per year. Over 30 years, the earnings would have totaled $15,000. That's not too shabby. But let's see how much of a difference reinvesting the interest could have made. The investor who reinvested the interest would have possibly earned $33,219. This is more than double the return of the other investor. This is the power of compound interest. Now, let's take it to another level and discuss the importance of time. Compounding over a long period of time can potentially lead to exponential growth of a portfolio. Let's look at another example to understand how important time is to compounding. Suppose two investors have portfolios worth $100,000 each. The portfolios hold similar investments. They both use compounding to grow their portfolios 6% per year. One investor needs the money to retire in 20 years. The other will need the money to retire in 40 years. Let's see what a difference 20 years can make. At the end of 20 years, the $100,000 principal would have grown to $320,713. Now let's see how much the other investor would have earned. As you can see, the additional 20 years of compounding resulted in the principal growing to $1,028,571. That's more than 3 times the return of the other investor. Now that you understand how time impacts growth, let's discuss 3 ways how you can harness the power of compounding. The first step, and perhaps one of the most important, is to start investing early. The earlier you start, the sooner you can gain the advantage of time. The next step is reinvesting earnings. When it comes to investing, earnings are typically in the form of capital gains and dividends. Some brokers may allow you to automatically reinvest earnings, or you can simply buy more investments with earnings from capital gains and dividends. The final step is to avoid possibly the biggest obstacle many investors face, which is taking excessive risks that can lead to large losses. After all, compounding only works if you're earning on your investments. Of course, always earning a profit is easier said than done, because investments sometimes make money and other times lose money, particularly stock investments. You can't guarantee your investments will make money every year, but you can avoid taking excessive risks that can lead to large losses. Large losses can potentially be reduced by allocating your portfolio across different asset classes, such as stocks, bonds, commodities, and currencies, and diversifying your portfolio within each asset class. To help reduce large losses, resist the temptation of taking excessive risks in the hopes of earning fast money. Because when it comes to harnessing the power of compound interest, slow and steady is a better approach.
So I left this intentionally because I want to make a point. This was just randomly from an online broker, have some tools out there as illustration, which is really cool. But the point I want to make, you'll find plenty of these options out there, but all of them are selling, to do business with them and so on. But what you need to see here, they are obligated to put disclaimers on every single statement they made. And the point I want to make for you guys, read the fine prints all the time. And that's just a message that goes for everything, not just investment, but it's even more quantified in investment because sometimes people lose because they never read the fine print. I left this piece to just simply address that. So that's it. These are my final thoughts that I want to leave you with, and then we can get some questions. We still have time. My final thoughts is really, it's important to manage your finance with urgency, not desperation. What does this really mean? You don't want to wait until you really need money. And it really doesn't matter if you are handed a trust account or inheritance, or you just simply have absolutely no money. It's still the same objective. You should treat it with the same urgency and seriousness, because you will be involved. And going back to the first statement, you are the largest asset. So you could have plenty of money, but if you do not carry it wisely, you would never be able to preserve it. And you could have absolutely no money, and you would remain with absolutely no money if you don't make plans. The rest of the stuff is just be proactive, and it's covered by what I just said. And you have to continue to own. It's a secret. Like sometimes you get confused. You know, why should I invest, and what's the reason to invest in a company? You have to find a reason to invest in a company, and volatility will go around that. And you keep your investment for as long as your reason to invest in the company stays valid. And as long as this reason stays valid, you should be a long-term investment in it. Once this reason changes, that triggers why you should sell this investment. And that goes to a lot of applications. But keep it in mind in how you assess, how you make a decision to invest or to sell an investment. Take control of your finance and don't leave it unsupervised with the hand of professionals. And allow professionals to give you advice, but always maintain your own risk tolerance and your ability of sleeping better at night and your personal investment goals. Take the professional advice, but try to customize it to exactly how you want to live with it. So with that, I will just open to questions. Oh, I did cover everything. That's impressive.
At what age did you start investing?
Well, I wish I was told when I was your age that I should invest and I should save. I was fortunate that my parents shielded me from that. But on the other hand, looking back, I was always curious about taking risk, investing, having an entrepreneur thinking. But at the end of the day, you just don't have an opportunity when you're provided for by your parents. Sometimes the independency cycle gets you to that, and the sooner you have it, and that's why we're here tonight, is to address that it's never, too early to start, saving and investing. Just answer a question?
Yeah.
Yes.
Could you talk a little bit about the internship opportunity?
Sure. We collectively, with the Blair wonderful team and leaders, we have an internship opportunity that will be on the New York Stock Exchange floor. We're working the details, and it will be announced. Dr. Miller will send an email to everybody about, we're looking at a creative competition, and so we have a winner at the end of the day. And probably you would fall under a lot of logistics, proximity, and where you're going to be at that time, and so on. But you should, Dr. Miller would send an email to everybody at Blair to have an opportunity to be part of it. Yes?
For high school somebody who have very limited knowledge about investment, what are the things that we should do to prepare for future investment?
Make an effort to look things up.
No, like what exactly are the things that we should look out for?
Well, you need to understand, read the financial news regularly, be involved from a knowledge standpoint of what's out there as far as investments, the talk of different markets, and see how every cycle impacts the ups and downs in the stock market. So financial news are a very good resource. Internet have many parts to do that. Did this answer where you are, or do you need more?
Yeah, thank you.
Do you personally try to beat the market, or do you invest in index funds?
I mean, logically, you really cannot, if you've been inside the market and understand the mechanism, you probably cannot really bet on anything because you understand the variables. So the best approach is to really have a logical approach of balancing whatever you're doing and be in a basket of various investments. Because outside of that becomes speculation. If you just speculate on a specific investment versus the message is investing for a plan that over a longer period of duration.
When most people invest in stocks, like when price goes up, they just kind of want to hold on to the stock, and they just get greedier as the prices go up. So they just keep holding on to it until the price drops, and they don't profit anymore. But as a professional investor yourself, where do you draw the lines? Like, oh, this is the price point, I'm going to sell on my stock. how do you?
Well, it goes back to the investment thesis. If you have reason to invest in a company, you continue holding a position as long as this reason remains.
Well, but your reason is, oh, the price is going up. So the price keeps going up, but then.
Well, the price going up is not a reason. Because when you look at a company, to analyze a company, to invest in it, you need to know what they make, how much they make it, how much profit they will do, and so on. So all these things happen, or the new products that they developed and so on. So all these things will keep happening while you're following up on the fundamentals of the company. The market sometimes will speculate, so sometimes they inflate the price. And it's your job as an investor or investor professional to identify what's an inflated price and what's a reasonable or attractive price as an entry point or an exit point when you invest. Make sense?
Yeah.
We have time for one? Yeah. I get a feeling that Mr. Fortunato has a question. I just get a feeling.
I always do. Do you think that the fundamentals of the U.S. economy are strong at this point, such that you recommend people getting into the market?
Well, I am absolutely not an expert on the subject matter, but I will take a shot at just observation of concepts. Typically, if you are investing for the long term, you have cycles where markets would go up and go down, and in some cases they go up significantly or they go down significantly. Just in the past probably few months, 2, 3, 4 months, the average stock market all over the world is down about 20%. So just logic would tell me, not that I will do that, but that logic would say, if I'm not invested right now, I probably will be better off investing now when the market is 20% lower than, let's just say, 6 months ago when it was 20% higher from this point. But also, logic would tell me, could the market go down another 20%? But at the end of the day, who will be better off? The one that bought into the market 6 months ago at 20% higher? Or if I bought now, or somebody else will wait another 20% and buy after a few months from now, if that's the cycle. So all these things get to confuse the investment thesis. So bottom line, try to really have a steady cycle of investment where you're contributing automatically to it, and it kind of like build to an actual exit at a set time. And this time is far enough, like you don't have to worry about 4 years of volatility, 2 years of volatility, 3 years, it becomes insignificant in the cycle. Does this make sense?
Yeah, it does. Thank you.
How about Mr. Compton? You are great in questions. All right. So no more questions?
Anything else? If you'd like to speak further with Mr. Sobhy, come on up front. Let's give him, well, we have one more question.
One more question?
Did you read The Big Short? And if you did, do you agree with its conclusions about the financial crisis?
One more.
Did you read The Big Short? And if you did, do you agree with its conclusions about the financial crisis?
I did not read The Big Short. I lived The Big Short, so there's a big difference. I did not read the book, and I don't know, and there would be a movie. But, you know, just being a student of the market throughout, you know, my career, you see some cycles that happens where it really gives you the alarm bells when things are just so skewed. If you remember, we talked about investor psychology, the herd mentality. It's very common. And most people that actually make significant bets against the herd, they usually, if they are right, they make a substantial amount of money. So this thesis has happened throughout the history of the stock market and the economy in the United States for many times, in many cycles, in real estate and other things, and this as an example of it. So could the average investor be aware of that? It's really hard to really put your hands on it, but the signs are always there. If you really spend enough time to look at different signs, you will see some signs that it just doesn't make sense that somebody buys a house at 110 value of it, and a bank is giving them a loan on that with absolutely no collateral or value for them to default, and they have no earning power to pay the loan. So just, these are signs, you know, so that's just my take on that part. Well, I have to really, well, one more question, Carlos? Go ahead, go for it.
A lot of debate gains tax. Do you believe that capital gains tax takes away the incentive for an investor to enter a hedge fund or something where they're making a little bit more money, and maybe if we had capital gains tax, they would invest abroad?
It's a great question, actually. It's just, and it's a three-dimensional question because it has many components that probably I have to break it down for the rest to see it. But in general, look at taxes and exemption of taxes is almost like handouts. You know, there is a system, then the system has to tax in a certain way. The argument could be how much would that percentage be. But somehow, if you're an investor, you probably have a little bit more than the average. And when you earn, you probably should pay a little bit on that. And that's how I think the logic behind, you know, taxing capital gain. Now, the ones that look at the tax codes throughout the world and realize, like Apple, if I build a plant in China, I will be exempt from all my profits. So now they are pocketing a tremendous amount of profit there. Now, if the U.S. Government decided to take to give them an incentive to bring that money, that's just a big, you know, subject of discussion. You know, how would this happen and how many tax rules will be broken down? But capital gain should not be the reason, capital gain taxes should not be the reason why you should or shouldn't invest. It should just be part of your overall cost. Like when you make an execution of a transaction, you pay costs to do that. And when you invest with a fund manager, you pay costs. It should all be calculated as part of your investment, you know, return on investment minus whatever cost you have to pay in. And you should also balance. There are a lot of incentive. Take college education. There are a lot of incentives and programs that makes it exempt from taxes, you know, and so on. So when you're making a big plan, you look at the area where you have exemption already, retirement plans and so on, and you look at the areas that have just capital gain taxes. This answers the question.
Well, let's thank Mr. Sobhy.